All right, it's 10 o'clock. This is David Moore with Equity Advantage, and today we are hosting Inland Private Capital, and actually an independent financial advisor that works with Inland day in, day out. And today's topic is actually going to be a lot of the potential tax reform that could happen depending on the election results. And then we're going to be talking about DSTs, not just what they are, but why you should be interested in them and what they can do for you if you're an investor or you if you're a broker. So I'd like to start off. We've got Mr. Robert Smith of Peregrine Private Capital joining us today, and Dan Wagner from Inland Private Capital. Actually, Inland Private Capital Corporation. I got to make sure I'm keeping all the inland companies straight. Is that correct, Dan? And I'm not going to spend any time introducing you. Dan, why don't you say a few words, self-introduction, and then why don't we let you get it kicked off? I'd like everybody out there to know if you need CE for this, real estate CE, please contact C Moore, C as in Celia, Moore, M-O-O-R-E, at 1031exchange.com. And she can work with you to see if we can get you continuing ed for it. And other than that, I want to point off to the right, there's a menu there, and there's a section on questions. We've got probably an hour and 15 minutes worth of material anyway, so if you have to go, I understand, I apologize. We were gonna send out another notice letting you know it's going to be a little bit longer, but you know, we told you you're going to get an hour anyway, likely go further. And if you've got questions, please don't hesitate to ask. We want to address these things. We don't want you walking off this webinar with more questions than answers, but hopefully you'll get a lot of great information this morning. And Dan, without further ado, why don't you kick us off and tell us a little bit about you and Inland.
All right. Well, thank you so much, Dave. And it's great to be with all of you today. I'm coming from Oak Brook, Illinois, is where our world headquarters here for the Inland Real Estate Group of Companies. It's about 32 degrees here in the Chicagoland area, and we're having a good day. I love working for the Inland Real Estate Group of Companies. I've been here for 17 years. I work for the guy in the gray suit. He's the chairman and CEO of the Inland Real Estate Group, Dan Goodwin. And all these four guys are teachers. They taught for the Chicago public school system, and they decided that they're going to start investing in real estate. They got other Chicago school teachers to give them money, and they invested in real estate in the Chicago area. We've been in business for over 50 years, and we do a variety of things: non-traded REITs, the diversified institutional funds, a lot of DSTs. Private placement. So Inland is a very full service organization. We have about 1,100 employees, and this kind of shows you the different buckets that we have. We also have Inland Bank, and we have Inland Home Mortgage. So, and we do PACE bonds as well. So very different aspects that we're a full service real estate, commercial real estate company. But I wanted to highlight to you, we're talking about the 1031 exchange, and really I wanted to explain the 1031 has been a part of Inland's history for a long time. These teachers, they left teaching after they became so successful, and they had limited partnerships is how they did everything. And they at one time had 42,000 apartments in Chicago. They were the largest landlord in Chicago. But when the tax reform happened in the 80s, the variety of those limited partnerships were underwater. And these four teachers would not allow any of their other fellow teachers and principals and family and friends to go bankrupt. And so what they did is they went and put all their money back in the company. They went to Walmart and they said, "Hey, Walmart, can we do sale leasebacks with you?" And Walmart said yes. And that was a defining moment in the company. And then they went to Treasury and they said, "Treasury, can we take these underwater limited partnerships? Can we take the people, individual folks, and 1031 exchange them into a fractional share interest into these Walmarts?" And Treasury is like, "Well, nobody really does that kind of stuff, but that you're going to save these people, yeah, go ahead." So that was a big deal. It's a wonderful life moment. And so that's where the 1031 exchange became a big deal for the Inland Real Estate Group. And from there, people wanted to invest in Inland all the time because nobody really has heard that before. And these teachers, they've built this company to where we purchased close to 48 billion, for sure $47 billion worth of commercial real estate, which is in every state except Alaska. So it's a pretty interesting story. But today, because of time, I wanted to go and talk about this whole concept of what are we doing, what's going on with the wonderful 1031 like-kind exchange that has been a part of the tax code for 100 years and had such a pivotal role in our company's history. Because these teachers didn't see this tax reform coming in the 80s, they didn't expect it was going to impact them like it did. Mr. Goodwin created my position, which is the Senior Vice President of Government Relations, because they wanted to basically have a canary in the coal mine to be able to wake them up, to let them know if there's going to be stuff that's going to impact them. So what my job is basically I work on behalf of Inland to represent us at all these associations that you see before you. So I'm kind of like the Tom Sawyer of Inland. My job is to get all of our associations to paint the fence for us. And there's a variety of regulatory issues and a lot of other things that we're engaged with. But one of the most important things we're talking about is the 1031. So with the National Association of Realtors and anybody that's a realtor on the phone on the call, it is a big deal to be part of that organization because they have the Realtors Political Action Committee and they have 1,400,000 members. Every member of Congress has a realtor attached to them, every senator, every congressman, congresswoman, and they know them and they love their elected official because they're usually good friends. And so when you have that kind of relationship and then you have the resources to put behind that, is a very effective, probably one of the most effective tools in Washington because it's a very bipartisan way to work with everybody. So the last tax reform where the 1031 was in danger in 2016, 2017, it was the Republicans were in charge and they wanted to do 100% expensing. But in the end, after working with all of our associations and talking to the elected officials, they eliminated the 1031 for private property or for personal property, but they kept it for real property. And there were over 10,000 realtors walking Capitol Hill to do that. We also have ADISA. Inland helped start ADISA. It used to be the Tenant and Common Association, that it transformed into ADISA. There's the IPA. Inland was at the very beginning of starting the Institute for Portfolio Alternatives. International Council of Shopping Centers we're a big part of. The Federation of Exchange Accommodators, those are for all the qualified intermediaries. They're kind of like the Jedi Council of the 1031. And NAREIT provides lots of resources to elected officials to teach them about real estate. And they have incredible connections. And of course, we work with the Real Estate Roundtable, the Mortgage Bankers Association, the Commercial Finance Council, a lot of different groups that we work with. But one of the things that we experienced during the last tax reform is that when you talk to a member of Congress, you're usually talking to their staff person, and their staff people are usually 22 years old. So I literally knocked on doors and I'd say, hey, I'm here to talk about 1031. And the staff would say, 1031? No, it's 11 o'clock. And so it's really there's like a million things that a congressman or U.S. senator can talk about because there's so many different issues. So to talk about this little portion of the tax code can be formidable, but it requires us to continually to educate them because it's such a big deal. So during the last tax reform, Inland helped financially pay for studies along with all these organizations where we all know that the 1031 is important, but we were able to quantify that. And that was so important with the Ling Petrova study. Those are two professors that did a microeconomic study. And then the Ernst & Young did a macro study. And then the National Association of Realtors, they surveyed all their members. So real quickly, the realtors found out that over 60% of their members have done 1031 exchanges, which is unusual because they're mostly a residential organization, but a lot of second homes, for example, are used 1031. So that's been interesting to be able to tell the elected officials. The other thing is with these studies, you clearly understand that people aren't going to sell. So if they don't sell, then that means that deals are not happening. So at the macro level, the GDP would go down between $8 and $9 billion a year. And it kind of makes sense when you think about it, when you look now on the micro level, because every 1031, there's about 30 jobs that are created when you do a 1031. So you have more money to spend because you're not having to put that money into the tax coffers. You're able to defer it, so you have the money to invest. So about 34% more money is put into properties. The idea simply is owners maintain and buyers renovate. And so when you do a 1031, there's a whole bunch of jobs and synergy that's created. So you create taxable experiences for the government with income tax. So the realtor is going to have income tax, the lawyer, the appraiser, you could imagine the contractors, insurers, title companies, buildings and material supply companies, so on, and it goes on. And then a lot of the different elected officials have been either a mayor or a county level person, or state person, and they know how important transfer taxes are. So if you didn't have 1031 exchanges, there would be much less transactions. So the transfer tax would come down to a screeching halt or close to that as well. But the other couple of different things that were highlighted in the studies is that you have about a third of the exchanges pay some tax immediately, but all in all, about 88% of the real estate transactions with the 1031 do end in some sort of taxable experience. And so the idea that you never pay the tax is wrong. It's just simply deferred. And then another important part of all this is to know that that the 1031 is a tool for a lot of the big REITs. REITs are an important part of a lot of pension funds. So pension funds for police, fire, teachers, that's how the people get their bread and butter to pay bills. And so when you want to have a healthy commercial real estate world for the pension funds, and the REITs are able to use a 1031 to be able to manage their portfolio. So we were able to keep the 1031, as I said, with utilizing all these tools and networks of people. And then we thought that, hey, the 1031 saved, we're going to go and just put our feet up and smoke cigars. Everything's fine. Well, guess what? It's Groundhog Day. We're back at it. We had in February, the Biden campaign put their tax proposal together, and they sent that to the Brookings Institute. The Brookings Institute contacted our associations, and they were able to highlight, hey, you guys should know that the Biden campaign wants to eliminate the 1031 like-kind exchange. They also said the Biden campaign wants to get rid of the stepped up in basis. So that sent shockwaves in the industry, as you can imagine. And so what we've been doing is that with the Federation of Exchange Accommodators, with the Institute for Portfolio Alternatives, with the realtors, we've been doing Zoom calls with Democrat leaders. As you know, how the process works in Washington, the House Ways and Means Committee is the committee of origin for anything tax, and then in the Senate, it's the Senate Finance Committee is the committee of origin. So we've been talking to lots of senators and congressmen and women to explain all the same details of what I just highlighted to you about why the 1031 is so important. And the other aspect that people aren't necessarily aware of is that farmers use 1031. And so farmers, when there's development coming out their way, as you see coming along, farmers are dirt rich and cash poor. So they're not going to sell for developers if they have to pay the capital gains right away. So the 1031 is a wonderful thing that helps farmers be able to manage their portfolio of land. And then the conservation groups love the 1031 because they know that they buy land from farmers to use that as buffer zones along rivers and streams to be able to provide wetlands and marshes that water can filter through and get rid of some toxins before it would go into the rivers and streams that go out to the ocean. So that's another important aspect of all this. I guess 20 years ago, there was some talk about getting rid of the 1031, and the conservation groups out west were the ones that saved it. But with COVID, yep.
Dan, I was going to say, 20 years ago, they wanted to change like kind, and they were going to eliminate, and actually the farms were going to, it was going to be true like kind. So the farmers would have been pigeonholed into that type of property going forward instead of, the nature of the investment rather than the form. So that was a huge thing. And that was, it would, of course, they always bind it together with something else. And so that change in like kind was also, they were trying to bait you with elimination of the 45-day ID period at that point in time. But yeah, that one change would have been brutal. And the other thing, I just interrupted real quick, the 60% number, I think that you gave earlier with residential, people and their awareness of 1031. So, as you know, I've been in this game for, 30 years almost. And we always used to say, and we've always said from day one, that 64% of the transactions could or should be exchanged. So I found it interesting that your numbers were right in line with what we've always said. You think about what doesn't fit, you think about just even residential transactions. Say we've got a fair number of people in 97, when the exclusion came into play, that section 121, it was something that meant something. 250 or 500, gave you a nice exclusion on gain in $1997. But in 2020 dollars, at least this far into 2020, we haven't made it through it yet, but you've got a totally different situation. So we have lots of people who convert, residential properties into investment to, shelter more of that. But, I just thought your numbers and what you were finding was interesting.
Well, it's and you lived it. So I was not in the industry then, and you lived it. So that's, I mean, it goes to show you, if you're in it long enough, you see it come around, right, Dave? It's like,
yeah,
it is Groundhog Day, right? I did want to highlight that when we talk to the Congress, the different Democrat leaders, one of the other things we highlight is that the Biden campaign put this tax plan together before COVID. And so COVID, you should never get rid of the 1031, but especially now that our commercial real estate industry is backfiring, the idea of getting rid of the 1031 now, it'd be like throwing a wrench into the engine, and it seized the engine. So we're really explaining that because the 1031 will help businesses transition. Hotels, retail can use a 1031 to be able to sell and then transition into other things. So that's what's kind of going on with the 1031. Now, the question that people have to me is they say, Dan, what's going to happen tomorrow? Well, everybody in Washington that I know, they all predict that there's going to be a blue wave, that the Vice President Biden will become president, that the Senate will become Democrat, and the House will get even more Democrats. So then the next question is, well, okay, if the Democrats take over everything and they implement this plan, how quick would the 1031 go away? Well, first of all, you should know we're Inland and all of these associations. We're going to work. We're going to go to the mattresses, as you would say in The Godfather. We're going to do everything we can, no matter what, to educate, and to hopefully prevent that from happening. But if they do get rid of it, my best guess is that it would take till probably the September of 2021, and then it would be implemented. And my best guess would be January 1st of 2022. Now, there is a caveat in the law. They're able to actually go back in time and say till January 1st they're going to make it retroactive. So that is legally possible. I don't believe it's probable. So if you are trying to figure out what to do with your clients that are 1031s, my advice would be to have them do them in 2021 and get everything done before the first of the year. So that's my best guess. But it is a guess, and you should know that the issue is that it is retroactive. So
Dan, sorry to interrupt you again. So if you're looking at the retroactivity of this thing, are we talking, I mean, we're literally talking about whether somebody realizes gain period or they've done an exchange? I mean, if the retroactivity, would they basically erase an exchange that had been completed? Is that what, I mean, I understand you.
So David, this is what's so important. With all the experts I talk to, they don't believe that will happen. They don't think that anybody would ever do that. But after they say that, they as lawyers do, they say, but there is a legal possibility that they could do that. But they said probably not. But it's important for people to know what the different possibilities are. So, look
at California. Look at California. They're looking at talking about taxing somebody for 10 years after they move out, right? I mean, so anything's possible. I mean, it's really frustrating for me because the guy that mentored me, got me into business, 30 years ago now. He talked about the hardest thing about the business is always worrying about it going away with the tax code. And like you said, I mean, it's almost 100 years old now. But every few years we end up having to do this fight, and really, I mean, thanks to all the groups that you mentioned earlier, that we still have the 1031. And the bottom line is anything that you do to stop liquidity in a marketplace is ultimately going to crush you with lost tax revenue, I would expect. I mean, like you said, the number of people that are paid one real estate transaction. I mean, you've got obviously the brokers, title, escrow, tax and legal, inspectors, finance people, you, me, I mean, we've got Home Depot, for goodness sake. But I mean, you think about all that revenue.
Dave, they quantified that. There's 30 jobs they verified for each 1031 that's done. So you're absolutely right. We know that.
Yeah, that's amazing.
So, And so then the other question that comes up usually from people is they ask me, okay, what's happening with the opportunity zones? The very progressive part of the Democrat Party wants to eliminate them. The Vice President Biden wants to keep them, but and none of this is locked in. There's no bill that's out before Congress, so this is just talk. But one of the thoughts is that if you do an opportunity zone, it's got to be connected to a nonprofit of a community. And so the idea of possibly, if you build an apartment complex, to have more affordable housing, like have 30 units out of 100, or you might have to build a park next to your building, next to what you're doing. So it would obviously take away money from the bottom line, which means that returns obviously would be lessened too. But so those are ideas that have been thrown around. There's nothing that I can tell you for sure, but those are the discussions that have been out there that I've garnered, and that's probably the quickest example. So the big deal is what's going to happen tomorrow. Everybody in Washington, I know, says it's going to be a blue wave. People outside of the Beltway, outside the Beltway, people think that President Trump is going to win re-election by a slim margin. They believe the Senate will stay Republican by 1 or 2 votes, and they think that the House will stay Democrat. So that's the outside the Beltway people. Inside the Beltway people, they just think it's a blue wave, and they're basing that on all of the polling data that's done. So anyway, that's kind of the gist. I kind of went over 20 minutes now. Now, if there's no questions, we can get into the meat and potatoes of talking about the 1031 and DST and getting Bob Smith in on the conversation.
Yeah, Dan, I don't see anybody's got any questions on this, but I just, I want to stress this stuff comes around, every few years. And I think the thing that's scary, it's like these incremental creep, right? I mean, we lost all the personal property with tax reform now, and OZs are now being attacked. Imagine, you lose personal property, now you lose the OZ too in the state of Oregon. I mean, they've already attacked it on the state level here. So, I think it's really important people are aware of all this movement out there, and you take away personal property transactions. Now they're talking about getting rid of the OZ and doing all this other stuff. So everybody out there, please, notify your representatives and tell them, hey, we need these things in place. And the other thing I would just mention,
tell them the location. Like they can go to the Federation of Exchange Accommodators. It's www.1031.org, and that'll have all of the white papers about these the Link Petrova studies, and you can type in your address, so it'll tell you who your congressman is or congresswoman, and then you're absolutely right. They should contact their elected official to let them know why this is such an important part of and helps people, because everybody on the call, they help people. They're in it to help themselves, obviously, to make a living, but ultimately, if you're successful in this business, you're helping people. And that's what you need to be able to explain, is how you've helped people with the 1031.
Yeah, the other thing, I just, you look at these things, and when they're gone, they're gone. But what I was going to say is we've got potentially, who knows what's going on after this election with real estate and everything else, but we've got a situation now where we've got a lot of people that aren't getting paid because tenants are having problems and the mortgage companies are told to sit still. But I just want to mention that, for everybody out there, you have to understand that in a foreclosure or short sale on investment property, you don't have any tax relief. So you're going to be subject, if the basis on the property is less than the debt on a property, you're going to have something called phantom gain. You could lose the property foreclosure and have a tax hit for the pleasure of doing so. So the last crash, we did a whole bunch of transactions bailing people out of foreclosures, and honestly, a lot of those people were going into offerings like Robert Smith had and Inland had at that time. But we got to understand that a foreclosure short sale on a residential situation, primary residence, you've got some tax relief. Income properties, you don't. So it's really important that people are aware of what the ultimate repercussions of elimination of 1031 would be on everything. But Dan, why don't you we'll continue along the way and leave the tax reform until after tomorrow.
Well, and let's jump in again, Dave. You're the expert on as a qualified intermediary. Do you want to tell everybody again your company and what a 1031 is?
Sure, sure, sure. So, everybody on this probably heard me speak before, and I just, David Moore, Equity Advantage, and my background was real estate investment, got into the business because we needed exchange work done, couldn't get it done in those days. So we put this company together in 91. But, the thing is, I was always taught, it's tax deferral, it's keeping your money yours. Every dollar you save, you got 3 or 4 more to reinvest. But the whole thing with real estate, I just love it in that you've got tools like 1031 to keep it going. Wall Street's got all trillions of dollars in qualified money on Wall Street via IRAs and 401k plans. So you've got automatic tax deferred transactions. A very small percentage of real estate's owned that same way, and we can help you if you want to do that through our sister company IRA Advantage. But the bottom line is that most of the time 1031's looked at as something just for wealthy people, but it's not. I mean, it's for the average person. I mean, an exchange is going to cost you somewhere between $500 and $1,500 to do a normal delayed exchange, and anybody can do that. So it's a tool that's been around since the 20s. It's an amazing instrument for anybody. You don't have to have high dollar tax and legal representation to do an exchange. You just call up your accommodator. So, and by the way, you can find us at 1031exchange.com. But I like simple. So when we look at these things, Dan, you've got the example of these things on a transaction now. It's your example if you'd like to go through it, or I can run through the thing.
For $1 million property, what kind of taxes and stuff, what's taken out of that without an exchange?
Let's look at it in today's dollars, right? Because we don't know what'll happen after tomorrow. But typically we're looking at a long-term federal tax rate of 20% on appreciation, 25% on depreciation recapture. State taxes are going to be on top of that. And also be aware that we've got, you were talking earlier about red and blue and what's going on with things. But if we've got a situation where lots of people are saying, hey, I want to exchange out of a state like Oregon, for example, into Florida or Texas or Nevada, even Washington state, let's say. And, the reason they do that is the state of Oregon's at about 10%. Now they added, Multnomah County's added another 1%. You've got another 4 potentially on there. You could be looking at a state of Oregon tax at 15% on top of the Fed's 20 or 25, depending on what type of gain it is. And you still have the healthcare tax at another 3.8. So, do the math, you're up close to 40% on stuff. And that's something that, people need to understand. As I said, gain doesn't mean you have a profit. Gain's simply the difference between the basis and the adjusted sales price, and your basis on a property is that purchase price plus capital improvements minus depreciation. The problem people have is let's look at the depreciation component. I had somebody last week I was talking about, and when we did personal property transactions, we were doing aircraft, say corporate jets, that type of thing. They typically don't go up in value. The gain's all triggered by that depreciation recapture. And that's, like I said, that higher rate. But we've got to understand that you could lose a property, as I said, with that phantom gain scenario, and you could lose a property, foreclosure, short sale, and have a big tax consequence. But if you look at this diagram here, you've either got 6. These numbers probably, at least on the West Coast, are a little generous with the 686. But you're going to have all your equity going forward. Every dollar you save, you got 3 or 4 more to reinvest, or you're not going to have it. So one exchange can put you, years and years into the future where selling and paying that tax. And it's the same exact strategy we employ with Wall Street, with IRAs and 401ks. Keep that money yours. We like to say you work hard for your money. We work hard to keep it yours. So when I look at an exchange,
it's a 401k of real estate. I love that. I love that, because you're right. It is a 401k of real estate. You're able to get the money working. Good idea.
Exactly.
Well, let me jump.
So, Sure, go ahead.
Okay, we're going to jump now to our friend, who's next to you, Mr. Robert Smith. If you can be on deck here, we're going to see if you can introduce yourself real quick, and then we can have you explain in general what a Delaware Statutory Trust is. Bob, go ahead.
My name is Robert Smith, and we own and operate Peregrine Private Capital Corporation. As such, we're the oldest retailer of DST, Delaware Statutory Trust properties in the nation. We actually helped catalyze the creation of the product a little over 20 years ago with Inland. We'd had a lot of success with Inland investing in their non-market traded REITs. We always had people coming to us after the fact because they had rental properties to sell, asking us, can I 1031 exchange into an inland REIT because they've done such a good job for me in the past? The answer has always been no, because it has to be direct ownership of dirt for direct ownership of dirt. And when you buy shares of a REIT, you're buying shares of a company which in turn owns the dirt. There's the disconnect. So we kept dripping on inland, telling them you really need to create a REIT-like product for the 1031 space because there's tremendous latent demand for it. And lo and behold, they came to market with it. 20 years later, are the 800-pound gorilla in this space with approximately 60% market share of the DST industry. So we are the oldest retailer in the United States, one of the larger retailers in the United States, and I believe we are the single largest provider of investment equity in DST programs for inland. DST, very simply, Delaware Statutory Trust, is just the legal format within which a portfolio of properties are owned. Delaware Statutory Trust itself has been around for over 100 years. So it's simply the mechanism by which these properties are owned and operated for investors. 20 years ago, when they created DST, it was usually one property, one program. The products matured tremendously over the last 20 years. Increasingly, individual DST programs look like small REITs with multiple properties of a type, whether it's apartments, self-storage, what have you, in one program. So you're not only achieving diversification, you can not only achieve diversification more easily with DSTs geographically than you can possibly do yourself, but the DST programs internally now are increasingly well diversified over multiple properties. And for 1031 exchange, it's simply the only truly passive mechanism for property ownership in the space. And the reason DST has been growing very steadily as a part of 1031 exchange, very simple, it's demographically driven. The population's getting older. And as everybody knows, managing your own dirt in your 20s, 30s, 40s, 50s is okay. It's not so okay in your 60s, 70s, and 80s. So ultimately, real estate owners find their way to the DST because they simply want an ownership format that better reflects their more passive retired lifestyle. And
Bob,
so,
Bob, could you talk a little bit about how DSTs are different than TICs, like in regards to the maximum number of investors? Because some people might have done TICs before, but are they responsible for the loans in DSTs, the ownership structure? So if you could hit some of those points, that'd be great.
Sure. Nice thing about the TIC, the tenant in common property, was really an aberration in the real estate space, because when Inland created or homogenized, rationalized the DST product for broad consumption or distribution, it was originally called a DBT, or Delaware Business Trust. It's the exact same thing as a Delaware Statutory Trust, albeit with a slight name change. That characterized all of the product for the first 3, 4, 5 years of the industry. Then a Treasury Department official made some disparaging remarks about the DBT format at an industry conference. Everyone stampeded to the TIC. Inland, having created the DBT, said, wait, stop, time out. This is our product. We know it's good. So they asked for a special letter ruling from the IRS specific to the DBT DST structure. Took 2-3 years to get it because it's the government. But in the interim, the TIC structure was used. The TIC structure was inherently flawed because to do anything substantive with regard to the property from a management or ownership standpoint, you have to have unanimous consent on the part of all investors. And the only reason people do TICs or DSTs is because they want to disengage from the management process. And so getting everyone back together to make timely decisions with regard to a property was like herding cats. And that's why so many TIC properties had problems in 2008 when the single family home market collapsed. the economy slowed way down, and decisions had to be made in a timely manner with regard to properties from a tenanting standpoint, management standpoint, and the TIC format inhibited that. And the TIC format also is limited in terms of the number of investors it can take. So it tended to concentrate assets in one property or a property. Whereas with the DST format, everything is done remote control, meaning property management has authority to do everything with regard to operation and ultimately sale of the property, which is the way you want it. You want that decision-making power vested in your single management entity. And it also comes with 9 out of 10 DST properties come pre-packaged with debt, because 9 out of 10 people in 1031 exchange need to replace both debt and equity to achieve a clean exchange. So the properties come pre-encumbered with a bank loan. Obviously, a large corporate entity like an Inland can borrow money much more cheaply than you and I can. I believe in talking to Keith Lampy, who's CEO of Inland Private Capital Corporation the other day, he indicated to me that some of the financing they got on their upcoming self-storage portfolio is actually under 3%.
Wow.
Lenders are being very aggressive, particularly with a large corporate entity like Inland. So they can borrow money more cheaply than we can. And as a signatory trustee for the loan, they're on the hook for the loan. As such, it's what's called non-recourse debt to the investor. So as an investor, you get all the benefits of debt in terms of meeting your debt replacement requirements in 1031 exchange. Obviously enhanced cash flow, because you leverage a property, you're going to increase its cash flow, and some additional tax sheltering via interest expense. So it all comes pre-packaged, so you as an investor don't have to go out and qualify for a loan with a bank. You simply need to find that DST property mix which best approximates your replacement property debt requirement. So,
and Robert, you also get depreciation, right?
Pardon?
You also get depreciation, right?
Yeah, it's DST property income. I mean, it is no different. It's straight rental income. It's no different than the rental income you have received on individual properties in the past. It's rental income. As such, it's straight 1099 Section E income from a reporting standpoint. You do not get a K1. It is not an LLC. As such, just like with your rental property and its income in the past, it is can be a very tax sheltered stream of income via depreciation of the property and the interest expense. So it is one of, not only is the 1031 exchange itself a significant remaining tax shelter, but the rental income received from DSTs is one of the last tax sheltered income streams available. As such, say a 6% starting cash on cash return on a DST property, when depreciation and interest expense is factored in, that's probably, and I'm just shooting from the hip here, that's probably an 8% tax equivalent yield, because a chunk of that is going to be sheltered. And along those lines, it's also important to understand, in terms of appreciation, a DST property is no different than the rental properties you have owned in the past, meaning you get your pro rata share of appreciation when that property is sold. Section 1031 of the Internal Revenue Code is very, very specific that the property syndicator or manager cannot participate in any gain or loss on that property at time of sale. So assuming the property appreciates over the ownership interval, the investment interval, then you as a investor receive your pro rata share of appreciation at time of sale. And historically, that's accounted for about 60% of total return on DST properties between annualized cash flow, which you've already received, and appreciation.
Robert, let's try to go with this phase one. Let's do it in 3 phases. So first phase of acquisition and subscription obviously inland, we have an army of people that buy stuff. Joe Cosenza, there's Guinness Book of World Records of somebody buying individual commercial real estate deals. It's Joe. I think he's done 3,500 or close to 4,000. But I wanted to ask you, what is it? We do our due diligence at Inland, but I believe your company does due diligence. And then could you talk about what do you need to do in order to get into a DST in regards to accredited investor? And if you could get into a couple of those things.
Hey, Dan, Bob, I'm going to hold up 1 second. Okay, I got two questions that came in, and one of them I want to make sure, actually, both of them we'll get to before we start this. So, first question, and Dan, I don't know if you want to address it. If 1031 is in fact changed under the Biden administration, people with AGs under 400,000 still be eligible to participate in a 1031, or what's up with the 400?
Yeah, so the Real Estate Roundtable, I've asked them that question because the 400 number has been thrown around. The associations that we work with, they said nothing's for sure, but that 400,000 basically still would mean that the 1031 would be like going away. They think that that's just a number that's put out there. It still would not be something that would be allowing a 1031 just after everything's said and done. So they're just basically saying the 1031 is going to be eliminated. So that comes from the Real Estate Roundtable. That comes from all the different associations. But because once you end up doing it, the 400,000 doesn't matter, is what they said.
So Dan, along those lines, we're not talking about somebody that makes 400,000 in wages. I mean, as soon as they sell a property, that whatever the gain is going to be put on top of that anyway, right? So I mean, 400 is just a number that could be. I mean, somebody could make $20,000 a year in income and have it get slammed with it. So I think that's just got really, people need to understand whatever you're making is getting thrown on top of the other. The second question that came in, and Mr. Smith, you just talk about it. Now, I mean, great description of DSTs, and I just sort of look at them as a small exchangeable REIT. But a REIT, you know, it's a dead end. The only way you're going to get into a REIT is through an UPREIT, and that's an end game. But you're not going to get out of that. There's a reason to use that UPREIT. Maybe you go into it, and then you can shift your gains into little tiny taxable events as you sell the stock. But you're not going to get out. Where the question that came in was, are the capital gains taxes going to apply when the DST sold? And tell them the beauty of that whole thing, Mr. Smith, because like I said, it is a small exchangeable REIT, really, but you've got the ability to do what?
Well, you've got the ability to exchange again. The mantra in the industry is exchange, 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 die, because the longer you stay in the 1031 exchange loop, the bigger your potential capital gains tax liability at the state and federal level, along with, as Dan mentioned earlier, depreciation and interest clawback will be. So again, Section 1031 of the Internal Revenue Code is very specific that at time of sale, the property syndicator manager has no control over client funds. You can do whatever you want. You can pay your taxes, take your money, take a trip around the world. You can say, thanks, Inland, that was a great management job, but I just found the hottest thing since sliced bread down the block, and I'm going to jump back into property management myself and 1031 exchange into that. Or, hey, this is a fantastic experience. Let's do this again. What do you have from a DST standpoint? So as long as you remain in that 1031 exchange loop, albeit with any type of product that qualifies, you continue to defer any and all capital gains tax liability. And unless Biden is elected and the stepped up cost basis is eliminated, DSTs are treated exactly the same way any other income producing property is at time of your passing. Your heirs receive that stepped up cost basis so that that capital gains tax liability effectively passes with you. So again, from a functional standpoint, from a legal standpoint, DSTs are identical to individual properties that you have owned and operated in the past, albeit you go from owning 100% of a very small property to a fractional interest of a very large and well-diversified property group. And you go from being in the I manage property or I manage managers business to the mailbox money business, where once a month you get a check, and somebody else takes care of the headache. So functionally, they're the same as your existing rental properties.
So Robert, can we get, so my guess, go back to the question I have for you. So the phase one acquisition subscription. So one of my points is that I believe your company also is an independent company from Inland, evaluates this stuff. And then you also, if you could talk about to get into these, being an accredited investor and what that means. If you could hit a couple of those things, it'd be great.
Yeah, you have to be an accredited investor. DSTs are securities. It is the purview of the Securities and Exchange Commission. So to sell them, you have to be a licensed securities broker. And as such, they're considered what's called an alternative asset. All an alternative asset is an asset whereby there is not a ready secondary market, meaning heretofore you have not been able to list a DST interest separate from the property in its entirety and sell it. So there's a liquidity issue with it. That being said, it's no more or no less illiquid than any other piece of commercial real estate. But because of the illiquidity issue, you have to be an accredited investor, which means you have to have $1 million net worth exclusive of equity in your home residence to invest in it, because they just want to make sure, securities regulators want to make sure that you can go the distance with the property. And in no small part, that's because, again, a big part of total return in DST properties has been the appreciation on a pro rata basis that's realized at time of sale. And that's very difficult to realize when you're selling your DST interest separate from the property in the entirety. It can be done. All you as a DST interest owner has to do is find a willing buyer, agree on a price, escrow funds, and Inland or whomever will do the necessary paperwork to change title to the DST interest. But the likelihood is you're not going to realize full appreciation, so you're going to leave money on the table. So you have to be an accredited investor to begin with. And the primary distribution channel for DSTs nationally is what's called the Independent Broker-Dealer Network. And an independent broker-dealer is simply a small securities broker-dealer that does not create proprietary or their own product. They simply serve as a third-party platform for other people's security products. And that's basically your first line of defense, or no, for practical speaking, it's your second, because an Inland's going to go out, they're going to look at properties for DST purposes, they're going to do their own due diligence on the property. Does this work for us from a portfolio standpoint? Does this work for us from a management standpoint? They actually have 2 checks. Their acquisition people look at properties first and have to pass on it. Then the management team has to look at the same property and pass on it before it's acquired. Then it's brought in-house, and then it's packaged, and then it's put out for sale through people like me to investors. And so Inland is your first line of defense in terms of its due diligence on properties and whether or not they are desirable. The next line of due diligence is the broker-dealer itself, which before they will put a DST property program on its platform, waits for a third-party report, independent report from either FactRight or Brian Mick and Associates, which evaluates the DST. Then they decide whether they or not it's appropriate for their platform. And then finally, it comes down to us, again, because we've been doing this for 20 years, longer than any other retail broker in the nation. We know all the players, who's credible, who's not. That's the whole subjective side of DST acquisition and ownership. There's the objective in terms of what does the PPM tell me? What type of property is it? How is it levered? What's the cash flow like? What are the demographics like? But there's always a subjective, which I think is as important, in many cases more important. Who is the management team that's going to be running this program, and what is their track record? Because we all know that good management can oftentimes fix a challenged property. Bad management oftentimes will ruin a good property. So we're the third level or filter from a due diligence standpoint in terms of guiding you to an appropriate or desirable property provider and individual assets thereby.
Hey, Robert. So if we look at DSTs, a lot of times, the industry sort of says, hey, use this as a fallback. Tell us, I mean, as far as like inland, I mean, a fund's fully subscribed, but how long is it typically between the offering and the full subscription? And do you guys tie it up and hold it? I mean, if somebody IDs it for an exchange, how long is that ID going to be something that's, I shouldn't say valid, I guess, but effective? I mean, something that can be acted on.
It really depends on who you deal with. There are probably only a handful of brokers in the nation who specialize exclusively in DST product. It's almost 100% of our business. Other brokers, securities brokers, can certainly do DST products, assuming that their broker dealer has a selling agreement in place with an Inland, a Pasco, whomever. Okay, that doesn't mean that they are an expert or specialist in the space. And business is business, and those brokers that year after year provide the syndicators, the property providers, with the greatest amount of retail investment equity get preferential treatment in terms of desirable product. That's all there is to it. And it's not only what's currently on market, but what may be coming to market, and desirable programs from a geographic standpoint, property type standpoint, cash flow standpoint, can sell out before they even hit the market in terms of being fully reserved. They're not sold, but they're fully reserved, because relatively speaking, these programs are small, and that's why they're not distributed through the Merrill Lynch's of the world, the American Expresses, whomever, because the product itself is small and it doesn't fit their platform of 15, 20, 30,000 brokers. It's more appropriate to the independent broker dealer network with 50, 100, 200 brokers. And so these things can and are subscribed very, very quickly. And so, like it or not, in terms of getting optimal product in the DST space, as much of it is who you know as opposed to what you know. You have to have access to the product, and we have access to the best product.
And then if you could talk about the operation now for phase two, what would people expect from these things in regards, is there any, the potential income? And would people have to have, would there be a capital call if there's a problem with them? Could you talk about that?
Well, I think the capital call is best question, because we've never had a capital call in 20 years, but then that's because the vast majority of our investor equity has gone to Inland. And even before the creation of Inland Private Capital, Inland Private Capital is a wholly owned subsidiary of the Inland Real Estate Group of companies. Inland Private Capital now is almost 20 years old. Parent company is 52 years old, I think. And even before IPC started, Inland was proud of saying, in our 30-some years of operation, now 50, we have never ever had a capital call. And so it depends on who you're dealing with. If you're dealing with, and we're not an Inland shill, because we have selling agreements with all the major credible property providers in the DST space. That being said, size matters in real estate. If you are a very big, well-capitalized company like Inland, then you can protect your investors from capital call, because you have additional or greater resources to draw from if a property presents itself and becomes challenged. And let's be honest, it's real estate, it's real property. If it can happen, it will happen. It's not like a security, buy today, sell it tomorrow. You're going to own this thing for a while, and you've got to work with it. So a big company like Inland has never had a capital call in its history. Other smaller companies in the DST space who are not as well capitalized or who are undercapitalized, whose only source of income is doing deals, I'm sure have had and will have capital calls.
So Robert, along those lines, we just had a question come in. Has a DST from Inland ever lost principal of the investor? What is the worst that can happen?
The worst that can happen is you can lose your principal. It's real estate. Property goes dark, the zombie apocalypse arrives, and I'm not making light of it, and we absolutely positively cannot re-tenant that property, and then the equity goes away. In 2008, to give you some background on the DST industry historically, when DST started 20 years ago, there were basically two companies present at the creation. There was Pasco and Inland. Bill Paso, who owns it, Pasco, he does not operate it any longer, great guy, lifetime real estate syndication attorney. He's credited with having created the template for the DST. He had a client in LA, sold commercial property, wanted to do 1031 exchange into a property he alone could not afford. Bill organized a buyer group, did the 1031 exchange, asked for a special letter ruling from the IRS specific to that exchange, that it was consistent with Section 1031 of the Internal Revenue Code. Bill got the letter back, you're good to go. And that was the template. Inland, much bigger organization, came in, rationalized, homogenized the product via extensive consultation with Treasury, IRS. So in 1999, we went from two property providers that were real estate companies that had a long background in buying, managing, and selling real estate for people profitably to, in 2008, the demand for 1031 exchange properties was so white hot. We had over 100 entities in the space, most of whom didn't know their ass from a hole in the ground where real estate was concerned. So all kinds of stuff was brought to market that should have never seen the light of day. And we would tell our clients until we were blue in the face, here are the 2, 3, 4 companies in the space that are credible from a retail and institutional standpoint. And if you can't find a property that resonates for you with them, don't do a DST, because the rest of this stuff is opportunistic. And when the recession finally hits, and we published to this end, all these properties are going to go away, and first the investors are going to lose cash flow. Second thing, if it goes on long enough, mortgage isn't going to be serviced, and then the property is going to be foreclosed upon, and then the investors, to add insult to injury, are going to have a taxable event on money they no longer have, and that's exactly what happened. And that's why when the dust settled and 1031 started coming back up again, 60% of the market consolidated around Inland. I think 20% consolidated around Pasco, because they were the two companies that best segued through the great downturn in 2008 from a property standpoint. Inland had challenged properties at the time. Everybody did. If we had a Linens and Things as opposed to a Bed Bath & Beyond, we had leases with the corporate parent, but if the corporate parent went into bankruptcy, then we had a problem. And if the space was dark and Inland Property Management decided it's going to take too long to relet this space, then they stepped in, as Dan mentioned earlier on in their history, and with corporate monies, they 1031 exchange investors out of properties that weren't doing what they were supposed to into properties that would do what they were supposed to. And so up until that point, Inland had been able to say that, I believe, and I may get the quote wrong, but no investors ever left and completed Inland real estate program with less than their invested equity. So it all depends on the company, the size of the company, the capitalization of the company. And unfortunately, most DST companies could not accomplish that. And that's why many of them went away in 2008, 2009, when the industry ramped back up. It's much better policed now. I think there are 30, 32 active property sponsors in the space, all of whom, with the exception of Inland, Pasco, and I believe AEI, which is a smaller, very high quality, all cash DST provider out of Minneapolis. All the other companies are post 2008 creations. So, that doesn't mean they're not good. Lots of them have extensive institutional experience prior to entering the retail space, like Blue Rock, Cantor Fitzgerald. But that's what I say, caveat emptor, buyer beware. It's everybody looks like a hero when real estate's going up, and all interest rates have done since 2008 is go down. So all real estate prices have done is go up, and you find out how really good your management is, whether or not you're swimming naked when things go down.
Hey, Bob, I'm going to take back. I know we're already an hour into it. As I said at the top, for those of you that have to go, I understand. I apologize. This is going to run probably an hour and a half today. For everyone out there, I want you to know this is all being recorded. You're going to have access to it anytime you want. And I'm sure Dan's going to make the PowerPoint available. Am I speaking out of line on that, Dan?
Yeah, I think if you show the video, I think that's probably what you're able to do.
Okay, all right. So rules. Okay.
Yeah.
So the other thing I just want to stress, Bob, we sort of hit on, there's talk about debt on transactions. And those of you that are on my webinars, I always like to say, we talk about the value and equity requirements of the exchange. We call it the napkin test. And I just want to stress out there that, debt, you hear people say you have to replace debt in an exchange, and that's not true. Okay, debt can go away two ways, one by going down in value, the other by adding cash. But with that said, Bob, when you're talking to somebody, if somebody comes to you and they've got, let's say, maybe they got 80% loan to value or something, or maybe they've got lower, but you might have an offering. I mean, tell the audience what the typical offering is, and then how you might get them to the loan to value that they need to be by blending different options, diversify, not just for geographical or type, but maybe they need to diversify LTV just to get them where they need to be for the exchange.
Okay, on average, DST properties are going to come about 50% leverage. That's the average. There are property programs that come with less, as I just mentioned. AEI, very high quality provider, small provider of all cash DSTs, no debt, can go higher than that. That being said, coming out, again, going into 2008, when banks would loan money to anyone, to anything, at any time, leverage levels kept increasing. And then everything collapsed. And so when banks started lending in, they were initially very conservative. They started out at about 30%, and leverage levels slowly crept up to about where they are today, 50, maybe 55%. You don't usually see much more than that. That being said, because we knew people would ultimately be coming out of much higher levered programs from pre-2008, again, at our urging, because we're securities people, we asked Inland, or suggested, that they create some real estate-like product, like a zero coupon bond, a very highly leveraged bond, say that is leveraged at 80%. You don't receive that coupon on a monthly or annual basis. It gets paid back in to the value of the security, accreting it in value. And that's exactly what Inland did. They went out and created a zero coupon DST, where they will find, whether it's an Amazon, a major insurance company, a AAA credit rated tenant, and they'll buy the property and they will aggressively leverage the program at 82 or 83%. And so it doesn't provide monthly income. That monthly income is paid back into the value of the property, aggressively retiring debt. But then you can buy pieces of that to add to your equation in terms of your loan to value replacement requirement. Granted, any equity you dedicate to that is not going to be cash flowing, but it's a very easy and convenient way to increase debt to a level that fully meets your debt replacement requirements, so you end up with no taxable due. So there's a lot of flexibility there in creating that level of leverage that you need, whether it's greater or lesser.
And Bob, what's the potential income?
A potential income is properties. You mean on properties generally, Dan?
In general, what could people possibly expect to receive from this from a month?
It's really property specific, meaning obviously the more popular a property type is, the higher the value is going to be, or higher price is going to be. relatively speaking, the lower the cash on cash return. For obvious reasons, multifamily has been the property type du jour in the DST space since the 2008 single family housing collapse, because you had a whole generation of should have never been buyers going back to being renters, and there wasn't enough supply. So prices have gone way up. Cap rates have compressed tremendously. Average cash on cash return, starting cash on cash return on an apartment property, if it's well located, in a red state, in a high growth market, it's probably going to be around 5%. Other asset types which aren't as elevated from price standpoint as multifamily, retail, what have you. Obviously, retail is experiencing lots of problems now via the internet, Amazon, that kind of thing. Retail properties can generate 6% because institutionally it's considered a less desirable asset class, so prices are lower. Corresponding cash on cash returns are going to be higher. So it's reasonable to expect, depending on the property type and its desirability, to see cash on cash return of between, say, 5% and 6%. I think that's achievable.
Hey, Robert, so along those lines, how's COVID impacted multifamily with the DST offerings? That was a question from the audience.
Surprisingly, we have had almost no occupancy issues. I mean, fortunately, if you look at DST property portfolios, 90% of the stuff's going to be in red states, because even pre-COVID, pre-lockdown, handwriting was on the wall, and then along comes the Trump tax bill, and that steady trickle of money, people, businesses moving out of high tax blue states to low tax, no tax red states became a flood, because you had the SALT provision limiting state and local tax deductibility to $10,000, and that was just put on steroids by COVID when the blue states locked everything down. So most of our apartment properties are in the Sun Belt, and we've had little or no occupancy issues, remaining uniformly high, 94, 95, 96%. We have had, obviously, rent collection issues because of the eviction moratoriums. And so most responsible DST property provider managers cut cash flow distributions on many multifamily properties from, say, 5% to 2.5%, 3% for the duration of the lockdown, so they could add to investor reserve, not knowing how long this would go on. Unfortunately, first there was the national moratorium, then the CDC moratorium, and now individual states have extended it. And so we have something of a free rider problem developing, meaning people who could and would otherwise pay rent look at their deadbeat friend who isn't paying rent and is still living there and decides not to. But that, of course, is all rent forborne. It's not rent forgone. So it is accumulating. And in many cases, most cases, DST property providers have done everything to bend over backwards to work with tenants that if they can't pay all rent, at least some of it's being paid, or it's being paid incrementally. So we've had no occupancy issues. Our rent collection has gone down. It should go back up as we move out of this thing. And if Joe Biden doesn't get elected, because Joe Biden is on record advocating for not rent forbearance, but rent forgiveness.
And then if you could talk about the dispositional, the phase 3 is dispositional liquidity. Is there appreciation at the end, and how does that work? And what do people do at the end of these things?
Yeah, actually every DST comes with what's called a PPM, private placement memorandum, and it's about as thick as a telephone book and about as interesting. And it's the property version of a mutual fund prospectus. So because of the full disclosure required by the Securities and Exchange Commission, all the due diligence you would normally have to do before buying a property yourself is already done, and everything knowable about that property, good, bad, indifferent, is in that book, fully disclosed. All you have to do is read it. Stamped all over that book is you should be prepared to hold this property or property program for 10 years. That being said, the average hold period for a DST property across all property types over the last 20 years has been a little over 6 years. Okay. Most DST properties are either new construction or newer construction, and there's an optimal ownership period where you're not putting money back into the property from a capital improvement standpoint, and you're still the sexiest thing on the block. So you're not having to compete for tenants with and discounted rent, tenant improvements, that kind of thing. So usually in normal market conditions, around year 5, the property syndicator will start to actively market the property. And assuming it's been a well-chosen property, bought at a reasonable price, and we've been able to significantly increase rents over the lifetime of the ownership interval, the property should increase in value. And again, by Section 1031 of the Internal Revenue Code, the property manager syndicator cannot participate in any gain and loss at time of sale. So all of that goes to investors on a pro rata basis when the property is sold, and you're free to do whatever you want to do.
And then, so that's the phase 1, phase 2, phase 3 of the DST. Let me jump over to David real quick. David, so if I have a yacht and I'm renting that out, can I 1031 my yacht? What can I 1031?
Not anymore. Like we said, we lost all the personal property transactions with tax reform in 17. So it's all just all the real property now, which fortunately the DST constitutes real property, right? So we can get in, get out of it without any issue. But I mean, it's a good question, Dan, because I mean, we did lose. I think my favorite thing to exchange was all the high-end cars we used to do, and I know Mr. Smith likes those too. But most of the time you don't make money on cars, but we had people doing very, very well with those cars. But I guess they're those terrible 1%ers.
I have never made any money on any car.
Well, well, you just started investing in Italian ones, right? So you've had all those German ones.
There you go.
Historically, but definitely.
If you flip homes, can you do a 1031 on flipping? And if you have
yeah, I mean, that's a great question, Dan. I think that's one of the things that sort of feeds into the holding with respect to Inland too. But no, I mean, we all hear the ads, see the ads for flipping properties, and the bottom line is anybody that flips properties, if they understand tax, they're going to get tired of doing that very quickly, because why buy, fix something and hand over normal income tax on disposition, because it doesn't qualify for 1031 because it's held for resale. It's a dealer asset, and no matter how long it takes to fix it, you're still looking at normal income tax rates. So yeah, I mean, we always like to look at things and see how we can make people, fit their situation. So we always want to know where they are today, where they want to be in 2, 5, or 10, and we're going to work with them to help them get there.
And so, how do I put my second home into, like, how long, if I wanted to have my second home, if I sell it, can I 1031 that? What do I have to do to make that possible?
Well, I haven't coached him at all, but Dan's just reading right into that. So second homes are not, second homes are one of those things. We've done exchanges of second homes for 30 years, but a lot of people say, well, you can't do an exchange of a second home. I can't remember how many conversations I've had, even with my in-laws tax counsel years ago. They were sitting there arguing with me over one of the family's properties and whether it could or couldn't be exchanged. So, a second home, if it's purely a second home, and I'm going to ask, those in the audience to talk their tax people to really ascertain what it is that you're relinquishing. But if it's a true second home, for a true second home to fit the exchange, it's going to require that you restrict your personal use to 2 weeks or 10% of the time it's rented for the 2 years pre-disposition. Obviously, if you're going into a DST, you don't have that situation on the up leg. But yeah, you need to understand what does or what does not fit. And earlier, Dan was talking about 60% of the transactions with residential, or 60% of the residential brokers, didn't know that they could or should be doing exchanges. We, as I said earlier, up to 64%. But you think about what doesn't fit. Property held for resale, that dealer stuff that Dan's pushing towards, that does not fit. So, what is time the thing that's going to dictate whether something's held for investment or resale? No, time's just a factor of it. What's a person do for a living? How often have they done these things? There's a whole series. We look at the Clarkowski case that's used to determine dealer status. I use that same court case when we're looking at IRA and 401k funds and investing into real estate without money, whether we're going to be subject to UBIT or not, unrelated business income tax or taxable income. So, duration itself isn't going to be the issue. And Bob, I guess, since Dan sort of threw out there, the flipping and all that, what happens, if Inland is having, a problem with something, or they see an opportunity? The normal hold might be 5 to 7, but have you seen them short cycle for different reasons? And we did get an inquiry from somebody in the audience talking about some hospitality property that Inland's got right now that has been hit badly with COVID, and how any advice for them at this point in time?
Yeah, we have hospitality properties, and actually very, very well sited hospitality properties too, in downtown Denver, which are centrally located from a business and an entertainment standpoint. We have one in Minneapolis, literally across the street from the largest children's hospital in the nation. It was brand new Marriott, purpose built to provide long-term care stay needs for people accompanying their children for medical treatment. And we have Hilton in downtown Nashville, which arguably is one of the fastest growing cities in the United States, and is all about a 7-block walk from the brand new $500 million campus that Amazon is building in Nashville Landing. And I think it's only 2 blocks from the Tennessee Titans Stadium. Obviously, when the government unilaterally shuts down all travel in the economy, hospitality was hard hit. That being said, Inland jumped into the breach immediately, renegotiated loan terms with all the lenders, so we're not in danger of foreclosure there. There is, our debt payments are being forborne by the lender. And as occupancy steadily increase, I think we're by way of example, I just saw recent occupancy for the Marriott Residence Inn, and I think we're back up to something like 76%. That's still below where we were pre-COVID, but it's way, way up from the 20-some% we were at in the middle of the lockdown. So unfortunately, it just takes time, because as the economy opens back up and as more business and recreation travel takes place, then we'll see our occupancies continuing to increase. And once they reach a certain level, then we'll be able to increase room rates. And then we will be able to start distributing cash to investors again. That's unfortunately, hospitality was very hard hit. Retail's also been hard hit. They guesstimate that and the internet share of retail traffic or transactions has doubled in the last 7 months, from 15% to 30%. And as a result of that, it's not an accident that Jeff Bezos became the world's wealthiest guy in the last 7 months, because the government pretty much handed it to him. And so they guesstimate that that's going to increase retail bankruptcies by 300% in 2021. Office has also been hard hit, because you had all of these people leaving work, and many are working remotely, have been notified that they were working remotely well into 2021. And guess what? When the government gives us the ollie oxen free, or the green light, and you can all come out from hiding now, a lot of those people aren't going to go back to their cubicles. That's all there is to it, because businesses are going to find out that we can do this just as well, just as efficiently, and more cheaply, remotely. So honestly, office isn't too far behind retail. One sector of the market that has been positively impacted from a cash flow standpoint has been self-storage. And it's not an accident that self-storage is the top performing asset class in commercial real estate over the last 15 and 20-year intervals, from a total return standpoint, at about 16%, because the demand drivers are death, divorce, dislocation, and downsizing. And COVID-19 was a world-class dislocation event, with all those people going home and all those students going home. So for demand for self-storage went up, and in addition to that, it's not on the political radar screen. You don't have tenants. You have people's junk. And there's no percentage for politicians to advocate for rent forbearance for people's junk. And junk doesn't vote. Okay?
So Bob, basically, I mean, if we look at the frame that's up here right now, it's just commercial real estate is like kind. And when I look at it like a retirement account, I look at two factors for somebody to make an investment. What are they going to make? What do they want to buy, and who are they transacting between or for the benefit of? When I look at an exchange, I look at four basic factors. One, it's got to be an exchange. Two, what's getting received have to be of like kind. So as Dan was, trying to pull teeth on me a few minutes ago with the second home deal, talking about like kind, we look at like kind and its application to real property, since that's all we've got left in 1031. It really refers to nature rather than form. So we can go and exchange out of that single family rental into a DST, or out of an office building into a DST, or out of mini storage into a DST. But I think the thing that's interesting to me about DSTs is if you want diversification, you can not only have diversification via geography, but asset type too. I mean, we can, if you've got somebody that wants to blend the self-storage with, maybe they do like hospitality or whatever it might be. You've got, seems like through Inland and your other sources, you've got the ability to give people a pretty safe diversification, whether we're talking assets or types or loan to value or geography. All those things pretty much apply, don't they?
Yeah, I mean, even pre-COVID-19, and you can, we blogged about this extensively on our website, peregrineprivatecapital.com. All you have to do is go to learn more, drop down, and there are blogs. We've been blogging about this extensively, that, this is late cycle investing. 12 years ago, in 2008, everything was cheap. Stocks were cheap, bonds were cheap, real estate was cheap. After 12 years of essentially zero interest rates and money creation, nothing's cheap anymore. Everything's expensive. There's more cash out there than there are good places to put it. Okay, so if you sell your property now, congratulations. The good news is you're selling at the top of the market. The bad news is you got to buy back in at the top of the market. And we argue that your best defense against overpaying for an asset on the way, one asset on the way back in, is to diversify as extensively as you can over multiple assets in multiple places. And the DST does that better than anything else in the 1031 space. And it simply does it better than you can ever possibly do it yourself. So even pre-COVID, diversification was our mantra, that to diversify against another possible downturn. Now with COVID-19, we wrote a blog piece called Unknown Unknowns, and its government has now become, I mean, as a real estate investor, we always had the known unknowns in terms of, okay, what are the potential damaging forces and elements that can act on commercial real estate to cause me to lose money? We knew what those were. We didn't always know when they were going to occur or what was going to catalyze it, but we had a good idea what they were so we could defend against it. And now government is what we call the unknown unknown, because it's so big, it's so arbitrary, it can come in at any time and negatively impact any type of property. I mean, the fact this, an economic close down by government fiat, by a small group of unelected officials who knew little more about this thing than we did, has no historical precedent. And it's had a real impact on commercial real estate. So if diversification was important before COVID-19, it's 10 times as important after COVID-19 to protect invested equity. And DSTs do that better than anything else, whether it's geographic diversification, functional diversification, both.
So let me ask you a question, because we're at time. Did you want to go into some of the details of a 1031? Like, is it too late to exchange?
Dion, that's what I was going to say. I think most of the people on the line understand 1031, and I basically, let me just hit the last two bullets. So one, it's got to be an exchange. Two, what's given received have to be of like kind. We've talked about that. Three, for total tax deferral, you need to go across or up in value and equity, and it's not all or nothing. So I tell people, look, every whatever your basis is, every dollar you spend beyond the basis represents tax deferred gain. I'm going to stress this more so today than ever before. Exchange what you're comfortable exchanging. Every dollar you spend more on something than you want costs you $1. If you don't spend it, it's going to cost you 35 to 40 cents. So I think it's really important that people buy what they're comfortable buying right now. And if we look at the biggest headaches with any exchange are always going to be time, that 45-day ID period, the 180-day total time. But the second biggest issue is that continuity of vesting, which means the taxpayer that relinquishes has to receive. And that's the fourth of my sort of bullet points. I'm not really that concerned about that stuff getting into your product, because I know, that person's going to need to ID something. And let's talk about the ID briefly, but there was a question that came in, and Dan, I don't really want to spend much time on 1031. I think people have got it. We've got, we're burning through a lot of time. We got a lot of presentation left, but what do you think is going to happen, Bob, with somebody like WeWork and that type of space, at this point? That was just a quick question. And let's get back in and wrap up to have you talk through the rest of the presentation.
Well, WeWork's already totally failed. I mean, SoftBank had to, they had, what's the guy's name?
I don't recall.
Yeah, they had to buy him out. And I mean, all WeWork was they were just subletting office space, but it was packaged as technology, and the guy was a brilliant salesman. But then when they finally came to trying to nail things down prior to the IPO, there were so many holes in the IPO in terms of double dealing, self-service, all that kind of stuff. The whole thing fell apart. And so to avoid writing the whole thing off, and I think, SoftBank had put something like, $15, $20 billion into it. They had to step in with another $7 billion, something like that, just to get his ass out the door so they could try to salvage what was left. So it's not a question of what's going to happen to it. It's already failed. It's done.
So there's an answer. So Dan.
Yes, sir. You wanted to finish up at in like 3 minutes, right? So
well,
I think
but I don't see that. We still have most people online listening and watching. So
okay, let's continue. So you said you already believe people already know the process of doing a DST, that you have to.
Yeah. I'm not worried. I'm not worried about the 1031. Everybody out there, if you got questions on the exchange, give me a call. We'll take care of you. That's right. It's something that we've got good. Let's get through your presentation.
We explained. Did you want to highlight what boot is, or is that you think people know that too?
Yeah, I think boots anything that's received that's not of like kind in an exchange. So that could be triggered by that debt to equity component that Robert covered a little bit earlier, blending your offerings to get people to the set loan to value they need on stuff. And
we did the do's and don'ts of 1031. I think we hit all these points on this slide too. So I think that's good. And then we talked about the benefits, obviously the management responsibilities that you get the tenants, trash and toilets, you get rid of that to travel time and tenants. So those are easy. We talked about access to institutional quality property. We talked about lower personal liability with the non-recourse loans. Don't get sidelined. One of the things I will highlight, and maybe Bob, you have an experience too, but a realtor in New York in Manhattan was able to get an older couple who had a deli they owned for years, and their capital gains were so high they would never sell it. They were literally slaves of the deli, going to make sandwiches till the day they died. When the realtor found out about the DST, they were able to get the people to sell, and the realtor was able to make a commission, and then most importantly, help the people to be able to get out of the deli into a DST. And Bob, do you have experience with how you've helped people get out, not get sidelined from realtor standpoint?
Well, yeah, I mean, when we first started doing this 20 years ago, we tried to emphasize to realtors that we're not a competitive product. We're a synergistic product. We're the end of the line. Whenever anybody comes to us for information on DST, we tell them that people only come to us when they're at the emotional give-up point. They want to stay in real estate because they know it. they're comfortable with it, they understand it, and they absolutely positively do not want the tax liability, but they're at a point in their life where they want to get out. They want to go on to something more passive and enjoy some of that deferred gratification. And so we're going to help you get a listing on the front end that you're not otherwise going to get unless you can show your client something even easier, less troublesome on the back end. And that's all DST is. It's mailbox money. And every month, our oldest client, our very first client, a gentleman by the name of Carl Ramsden, came in the other day. And Carl just had his 90th birthday. And he started, doing 1031 or doing DSTs with us 20 years ago. And all he does is travel. And so it allows you to get out from under that ownership management burden, particularly for older people, because they don't know anything else. And so you can provide that solution. You can, basically what you're doing is, most small business owners, many small business owners, don't have an exit strategy. It's like, this is what I do, this is what I know, this is what I'm comfortable with, I enjoy this, and I make a good living. And so, but it gets to a point, we all get to that point from an age standpoint where I've got to think about exiting. And so a DST can realistically present all kinds of small business owners and small property owners with an exit strategy that they don't otherwise have. So you're helping them segue into that next phase in their life, which they may otherwise never get to.
Perfect. And then estate planning, I think you guys touched upon this. Did you have anything else you guys wanted to add?
Yeah, hey, Bob, have you ever had anybody, this is a question from the audience that you worked with that was interested or that you talked to about going into an OZ versus a 1031 in the DST? This means deferring capital gains. And I guess one quick question or comment on that. Please, 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 if you're in an exchange, you're going to go into an exchange right now, make sure, number one, this time of the year, you've got to look at your the timelines on 1031, say 45 or 180 days. There's an asterisk there, 180 days of the due date of your tax return. So if you're starting an exchange this time of the year, please do not file a return until you've completed the exchange. If you're not going to complete the exchange till after April 15th, file an extension, but it's critical you complete the exchange before filing that return. The other comment I've got, if the OZ, that opportunity zone, you've only got 180 days to get into that too. We cannot, as an exchange company, send money out of here outside what's called the 1031 G6 rules, which in a nutshell say you cannot get money from us until you've purchased everything you have the right to buy. So when you get the 45th day right now, it is critical that you are either committed to completing the exchange, or if you're interested in an OZ, you ought to torpedo the transaction. Tell us, if you did an ID, rescind it. You can only rescind it pre-45th day. But it's really important that you understand that 45 days is a hardline time. After that 45th day, you've either committed to completing the transaction or you should terminate it, because if you're putting a property in there just as a fallback, you don't have an OZ as an option, period. So with that said, Bob.
Actually, no, not. The Ozone and DST are two very, very different products, from the standpoint that, again, by law, by Section 1031 of the Internal Revenue Code, all DST properties have to be, quote, fully stabilized. That means they have to be built out, tenanted, and cash flowing. So you're not going to see a development program in the DST space. And so people come to DST, one, to avoid capital gains tax liability, two, to create a reliable monthly cash flow. And all the Ozones programs that I am aware of are development projects. So realistically, there's not going to be any cash flow in an Ozone project for probably the first 4 or 5 years. And that's more of a total return product. So no, we haven't had people coming to us everyone we've dealt with is income centric. And so, they ask questions about the Ozone, but as soon as they discover, and I'm not talking them down, but as soon as they discover that the Ozone does not provide predictable monthly cash flow, they pass. So they're two very different client types.
But by the way, if you've got more questions on opportunity zones, just type in on YouTube Equity Advantage 1031 or Equity Advantage Opportunity Zone. There's a whole series of videos on that topic with one of our region's actually top lawyers in that topic. So thank you, Bob.
And really the last thing is the insurance, the idea of an insurance policy. I was at the Texas Association of Realtors, and a realtor came up to me after my presentation and said he lost his best friend. I'm like, oh my God, did he die? And the guy said, no, I was his realtor. I sold his ranch for $15 million. And at the last second, the deal blew up, and he ended up having to pay $4 million in taxes. So this guy said, if I knew about the DST, I could put that down as one of the 3 properties that I identified. And so I think that's an important aspect too, to be able to, for especially anybody in commercial real estate, any brokers or anybody, to put that down as one of their 3 choices.
So Robert, with that said, I mean, sort of an insurance policy, but also, don't you have a fair number of people to go into those just as to fill the gap in let's say the napkin test, that value equity requirement of 1031? I mean, a lot of times people buy an asset or 2 that they really want. They've got a piece of that, a piece of those exchange proceeds left they don't want to pay any tax on. 1031's not all or nothing, but is it a situation where you have lots of people that are just picking up a DST to fill up that gap?
Yes, we do, as a matter of fact, and we go out of our way to encourage people to use DST as a fail-safe device. And can't tell you how many times we've done that we don't necessarily get the business, but we're backup, so that if for whatever reason the primary deal falls through, blows up, as David just mentioned, or as Dan just mentioned, then you still have something to count on to save your exchange. We do that very frequently. And because of the fungibility of DSTs, meaning every PPM comes again with printed on it, recommended minimum for 1031 exchange from an equity standpoint is $100,000, recommended minimum from a cash standpoint, because DSTs can accept straight cash transactions. About 20% of DST interests are consumed by people they've got $50, $100, $150,000 sitting at the bank earning nothing, and it's like, okay, that 5 or 6% tax shelter cash flow looks pretty good to me, and liquidity isn't an issue. So that being said, DSTs are infinitely fungible. As long as there's equity available in the program for investors, you can slice it and dice it any way you want. So they're really, with the availability of DSTs, and there are always DST programs on market, okay, because there are 30 active property providers. Somebody's always got something. So with DSTs, there's absolutely no reason for anyone in 1031 exchange to ever have taxable boot.
So Robert, the thing is, I mean, we're talking primarily today about 1031 and into the DST, and you talked about you can take money out of your pocket, put it in the DST. And I know the answer to this, but I'm going to ask you, how about qualified money, IRA 401k funds? Will you guys place that? And I mean, and some of you out there might be saying, well, gee, why would I buy into the DST instead of a REIT without money? Well, because you want to have the benefits and burdens of real property ownership, obviously. So is that something you guys can accommodate as well?
Yeah, it's program specific, meaning some DST property providers and some DST programs allow for investment of qualified money, are written up or underwritten in such a manner that it allows for that. Some don't, but it is available. It is in the space. It's simply program specific.
Thank you.
Well, this is our program, guys. I think this has been terrific. I appreciate the audience staying on for this long time period. We hit the highlights of what's going on with the 1031 and the world of politics, but hopefully everybody recognizes the fact that today having one of the best qualified intermediaries and one of the best financial advisors has been incredible. You guys know your stuff. And I learned more today as well, because you guys are so good. So thank you for this opportunity.
Well, thank you.
Thank you, Dan.
And Dan, I'm glad we could do it. This was something that was supposed to have been done in another format last week, and I'm glad we were able to pick up the pieces and get it together so quickly. For those of you out in the audience, thank you so much for joining us. Well, I think we covered most of the questions we got during it. If you've got questions that were not put out today, please don't hesitate to reach out to Cmoore, C-M-O-O-R-E at 1031exchange.com. That's Celia. She'll be able to address those things. If you've got an idea for a future presentation, something you'd like to hear more on too, please don't hesitate to let us know that. But you know, it's really amazing how much information we can get out in an hour.
Well, thank
Smile,
you guys.
everyone. Come on. It's like imagine. It's amazing how far you can go at 55 miles per hour, right, Mr. Smith?
Right.
So, you know, I wish everybody the best. Anytime you got questions or concerns, don't hesitate to reach out. You will be receiving information from CC with the contacts for the people that participated today. Thank you so much for joining us today, and best of health to all of you. And we got holidays coming up. So we had our big one, our 29th birthday. Our fiscal year is 1031. And so 1031 for an exchange company that was started 29 years ago on 1031 with a fiscal year ending 1031. Last week, Friday, was a pretty big day for us, but this is a great way to start off the week. And thank you so much for participating today, and all my best to everyone out there. Take care. Once again, David Moore, Equity Advantage, 1031exchange.com. Thank you, Dan. Thank you, Robert.
Thank you.
Thanks, guys. Take care.
Bye-bye.